Welcome to the daily update, where I'll go over the action in the market for Tuesday, January 28th, and we'll see how things look for Wednesday, January 29th. Okay, saw a bounce. The mega caps and semiconductors were weak on Monday. That was what everybody was talking about, with DeepSeek being released in China. And then Tuesday, we saw a nice little bounce with the mega caps and semiconductors. Growth had a good day. But the rest of the market was weaker. Now, we do have the Fed coming out and making their announcement Wednesday afternoon at 2 p.m. Eastern Time. After the close on Wednesday, Microsoft and Meta will be reporting earnings. So there's a lot of catalysts in there that could have a real impact on the market. So we could see things calming down a little bit. But at least in Tuesday's session, volume was above average and there was a lot of action. The S&P has been able to recover some of what was lost. So things are still looking positive. We're just a little bit concerned that we're seeing some weakness throughout the rest of the S&P 500 and the broader market in general. Okay, so right at the open, we had pretty much a flat open. The futures didn't really have a gap either up or down, so we just kind of opened where we closed after Monday. And initially looked like, okay, here we go. We declined down to the daily pivot, that 6,000 level, which for the daily pivot was 59.97. And then we climbed back above the unchanged level. So price turned positive. We got above R1 at 6,032 and then R2 at 6,052. Then we declined back down to R1. Then we climbed back up to R2. We hit resistance at 60.75. And then we closed slightly below the intraday high. So it was a pretty healthy day looking at the price chart, which I'll show in a moment. We were up 0.92% on above average volume. We have switched back to positive. Excuse me. We have switched back to positive with our trend indicator that we use that I'll show you. But we continue to be positive even after Monday in the short, intermediate, and long term as measured by moving averages. Interest rates did go back up. We'll see if there's any change to the overall scenario with the Fed coming out on Wednesday. There's not going to be a change to interest rates, but it's what's their stance going to be? Are they going to be more dovish, more hawkish? What's the pushback going to be from statements that President Trump has said, from Jerome Powell, and all the little games that go on politically, even though the Fed is supposed to not be political? And that's kind of what's feeding into everything right now. Even though there's all kinds of things going on in the world, it's more what's happening domestically within the US right now. So mega caps and semis rebounded after Monday's severe decline. Now we didn't get all that back. There's still a ways to go. And I just love this when people say, "Well, Nvidia lost 600 billion in market cap in one day." Or if there's a big owner of a company like Elon Musk or Zuckerberg, well, he lost $5 billion of his wealth today. It's easy to do that and it sparks emotion, but it really doesn't mean anything over a period of time. The SOX index, now this is the one that's been more negative. It's actually in a downtrend, and I'll show that later on. We were up 0.545% after falling 9.2% on Monday. And Nvidia did climb 9%. They don't say how much was added back in market cap, at least what I looked at, after declining 17% on Monday. So it was in a bear market for one day because it fell more than 10%, and now it's down a mere 8% from where we were after last Friday's close. And growth was strong where value was weak. So we saw value strong on Monday, and that was helping the internal structure of the market. Where in Tuesday's session, even though the megas and semiconductors did well, and growth stocks also, there was a little more weakness that we saw coming in. And you'll see that when I start going through the charts. We're still below the 50-period moving average with the small caps. They just have not lived up to what the expectations were for that. And a lot of that can probably be blamed on rising interest rates. Since they have to borrow so much money, that really affects their bottom line. On a short-term basis, we do have one of our short-term indicators that is getting extreme negative, which is showing good momentum again after all of them fell off pretty much after Monday. The Williams percent R is showing good upward momentum. The stochastics are still extreme positive. The slope oscillator, we never did change even after Monday as far as our momentum oscillators. And the slope oscillator continues to go up. It's getting kind of extreme, which also suggests good momentum. And then the 20 period moving average study did decline just a little bit there. Intermediate term, we're still looking rather extreme with our advanced decline line study based on 10 periods. It came down, but it's still giving a very high reading after giving a really, really high reading. The PMO studies are still looking extreme, and now we have one of our smart money indicators, the Chaikin oscillator, is starting to get extreme positive. And then the mass index. This is an indicator that I don't use very often, but I have been showing lately. This tries to say, okay, whatever happened to make this trigger, and there are three criteria. Well, the third was triggered after Tuesday's session. And then whatever is triggered, this anticipates that there will be a reversal. So we don't use this all by itself. We use it in conjunction with other indicators, and we don't necessarily base things around Fed days because it's all emotion there. There's usually the initial reaction, then the counter reaction, then the market kind of figures its way out, and then we've got earnings that'll be coming out after that, which can quite often go against logic. So, like if Meta and Facebook or Meta and Microsoft come out with really good earnings reports, if there was a lead up into that as prices were going up, which Apple, that's they're getting ready to report. We've seen a real nice bounce there lately. What's going to happen after they report? Are things going to see a decline because it's buy the rumor, sell the news? But then there's other times when it's looking solid. They come out with a good earnings report, and then they just keep going up after that. So this is roll of the dice type stuff to see how the market's going to react to these things. Then no change right now to the scenarios as it involves the Fed. We'll see if there's any modification to that after Wednesday's session. The dollar was up, interest rates were up. We're at 4.55%, or we had been at 4.53% with the 10-year yield. Sentiment is still negative. We have one more tick. If we get up to 45, that's where it goes into the neutral bracket, where we had been at 39. And we're back to looking positive again with our trend. After Monday, the red line crossed above the green line, turning things negative with our ADX indicator. With Tuesday's bounce, the green line has now gone back above, and I'll show you that chart. But we're still not trending right now. The ADX is below 20, and it's also below its moving average. The bias with the update is positive, and I've changed the momentum mixed to positive. The reason we're still mixed here is because the broader market really didn't show that much strength in Tuesday's session like it did in Monday's session, where even though we were down, we saw a real improvement with a lot of our indicators. Well, we were up on Tuesday and we've seen some weakness with some of our indicators. Okay, so we got the durable goods order that came out down 2.2%. They expected it to be up 0.4%. Last time it was down 2%. When you take out transportation, it was still up 0.3%. They expected it to be up 0.5%. Last time it was down 0.1%. The FHFA housing price index up 0.3%. Last time it was up 0.5%. The Case-Shiller home price index up 4.3%. They expected 4.2%. Last time it was up 4.2%. Consumer confidence 104.1, weaker than the 108.1 they had expected, and also down from the 109.5 that we saw last time there. So some charts. Durable goods orders year over year, still below zero, but bouncing up here. When you take out aircraft, above zero and going up. Month over month, a decline greater than what we saw last month. The FHFA housing price index just continues to go up as housing prices increase. Now, if you own a house, that's an increase in your equity. You like that. But if you're trying to buy a house with prices going up and interest rates going up, that can make it a lot more challenging. And then month over month, we actually saw a decrease in the house price index. And the Case-Shiller Home Price Index actually has this coming down. It topped out over the summer and has been declining. And then on a year-over-year basis, actually ticking up on a yearly basis from what we saw previously. Consumer confidence, that breaks it out into three different areas. The blue line is the total reading, which is coming down from the previous reading. And then how people are feeling right now, the purple line coming down a little bit, and how do people feel looking out into the future, also coming down from previous readings. And then looking at the weekly chart here of our overbought, oversold composite coming in at 80.6. We're above that 80 level, so the market's getting a little bit more overbought, but it could still go higher to the upside before it gets really extreme. Then post-election years have been very strong lately. This goes back to the post-election year, going back to 1985, where we tend to be up really strong. But if you go back further to 1950, we're up, but not as much. A midterm year, that's where things tend to underperform. And then the pre-election year, that's what we're just coming out of, 2024, they tend to be pretty strong. And then the election year, sorry, that was the year before. Then election year was what we just came out of. They also tend to be strong. So, but then we've seen other measures of this that show the post-election year underperforms. So again, you can take this data, chop it up different ways, and have it reach different results, depending on what you want to do with that. Then, how do things perform in January? Now, we're coming up to the end of January on Friday, and that can often be a really good indicator of how does the rest of the year go. And here, when you have a positive return in January, we're up with the returns about 19%. When we don't have a positive January, it's zero. So you can see January can be a good barometer for the rest of the year. And then the win ratio, when it's over, when we have a positive January, we're up 89% of the time. Where we're up, it's 50-50. You can toss a coin with how things are going to return going forward. This is kind of a variation of a different chart that I've been showing, and I'll show my version later on. This is a trend channel, and we're again, this is more like the one that I draw, and then I have a midpoint coming through here, and actually this one's going up a little bit higher on mine, where we're hitting the upper end of the trend channel based on the chart that I show here. But looking at this, we're still looking positive, but the chart that I have shows us hitting overhead resistance right now. And then forward-looking PE ratios, just breaking it down on the different sectors and then looking at the S&P itself. I typically go over this not by sectors, but I look at the whole market of the S&P 500 in the intermarket analysis video each weekend. And this just gives you the current PE ratio looking forward. And we use that 10, 15, 20 scale, where 10 and below is considered inexpensive. Between 11 and 19 is fairly priced. When we get above 20, that's when the market is considered to be expensive. But we can stay that way for long periods of time. And sometimes that fact that it is expensive and stocks keep going up just means, okay, we're willing to buy something that's already expensive with the hope that it's going to become even more expensive with price going up, as long as earnings are still looking to grow into the future. And tech stocks are expensive. Another valuation method here that is being used, but sometimes it's like the market doesn't even care about this. Usually this really comes out when we have declines like we had on Monday, and these charts were posted before Tuesday's session. So whenever we're really starting to go down, you see more valuation type of an emphasis. Flows into crypto, even though we're having a difficult time really breaking above the 100,000 level. I mean, we're above it, but it's not continuing to just go up after that. We're kind of chopping above and below it. We're still seeing an awful lot of money going into crypto. Now, I'm talking about Bitcoin specifically, but you can break this all down into the different cryptos. And this just basically shows what we've been talking about, where It's the big stocks that are really driving the S&P 500. That's this kind of greenish line here, the correlation between the top 10 stocks and the S&P, or the yellow line, that's the rest of the stocks, and they don't have as much of an impact. And that's what we watch on a day in and day out basis. It did well on Monday, but didn't do as good on Tuesday when we were more under pressure in Monday's session. And this just looks at different recent presidential elections and what was the performance after that. And it's usually pretty positive. It's not so much who the president is, it's more what's happening economically. Then this is when earnings reports come out, how do stocks do typically? And going back to 2018, they tend to do quite well because earnings have been pretty strong during that time. And this is interesting too, and I take two sides when we look at short interest. These are folks that short the market, which means they're going to make a profit if the S&P goes down. Now that can be quite dangerous, and you have to have really high margin requirements to directly go in and short the S&P, which you can play the downside of the S&P, but you can use ETFs and even options to do that without taking on that added risk. And maybe that's what's happening here. But we're coming in with a very low short interest reading right now. It just means that there's not a lot of folks that are negative on the S&P. Okay, that could be taken as positive. On the negative side, when they directly short the market, they sell to get in and they have to buy to get out. So if they start losing money because the S&P is going up, this can be what's called a short cover rally or a short squeeze. When the market's going up, they have to close out those positions. They have to buy to close them. And that has a sideline of built-in buyers because they have to buy, and that can push prices up even more. So there's a positive side here that the short interest is low, but it can also be negative, meaning that there's not a lot of short covering going on if we really start to go up. And buying the dip, now I personally, I don't do this. I buy into strength, I sell into weakness, but that's not what most people do because what's a dip? Is it 1%, 2%, 10%? You get people that think the dip is here, and then it turns into an even bigger dip. And instead of being on the offense, now you're on the defense and you're losing instead of thinking you should be winning. But I let other people do that since this is a favorite strategy of a lot of folks. Good buying opportunity. Is this good to do this? I let the market prove it to me, but that's different than what most people do. And we saw this, that we saw some buy the dip coming in after Monday's decline as well. And that helps give support to the market because when prices go down, suddenly people think they're getting something on sale. Well, I, you're gambling at that point. I like to play things a little bit differently, but I keep an eye on this, and I realize most people do this. And the general attitude is to, okay, if price is falling, I think it's stabilized, I'm going to buy. But you're going off an emotional thing at that point. There's really, there's stock market logic and there's your logic, and the two don't often have anything to do with each other. But we still keep an eye on this anyway. And then capital spending is a percentage of okay, annual revenue. The takeaway from this is the big companies, Facebook, Microsoft, Alphabet, Amazon, or Google here, they plan on still spending. They want to invest in all the different um, things, that projects and technologies and visions that they have. And that's a good thing. Because if they weren't really doing a lot of spending, that could have an impact on the economy. So my personal take from this is positive here because they're reinvesting back in, looking at things as growth potential into the future. And then if you take out tech, we're coming off of an all-time high. Well, tell that to Tuesday, where you just look at the S&P 500 itself, where this is after Monday with the decline that we saw here. And this was the internal strength that we saw happening in Monday's session. That's why a lot of our charts really improved after Monday. Well, they didn't really follow through into Tuesday session, even though the mega caps and semis bounced back up. All right, here's our intraday chart. And most of the loss that was seen on Monday was the gap. And then a lot of buying came in here. We pretty much stabilized. There was some choppiness along the way, but there was some buying in here. And we ended up closing at the intraday high, which made things look more positive. Too bad you can't just take out this little gap here that really made things look a lot more negative. And then we had a bit of a choppy open. We were able to set the support level at the daily pivot and then go up. We got above R1. We got up to R2, came back down to R1, and then broke above that. And we hit some overhead resistance at about the 60.75 level. A round number, a lot of strike prices there. So that it kind of stalled, at least for the time being, at that level. And looking pretty good here, where this is actually not that bad looking. If you go all the way back from Sunday when the futures first opened, and then we have that real gap down, this is pretty healthy looking on an intraday basis, although we're pretty much flat right now in the initial overnight session. And we saw a real drop off in growth on Monday. It bounced back on Tuesday, where value had really improved on Monday and it was pretty much flat on Tuesday. And we saw a bounce back up with the growth to value ratio intraday for the S&P. So we're back above the 20 and 50 period moving averages with the Qs. So that helps things there. Growth was up where value ended up being down. It was just the opposite of this after Monday. Growth was down where value was up. And we were up with the mid caps. We were also up with the small caps. So our end of day ratios are looking a little better. They're bouncing back for the small caps, the mid caps, and the S&P, where they really fell off in Monday's session. Bouncing back up, still trying to get out of the rainbow here with our growth versus value ETF. And discretionary, which fell on Monday, bounced back up on Tuesday compared to staples. And we're back above the 50-day moving average now with large cap growth. So some damage was repaired, at least with the large caps, at least with growth. And we are really choppy right now. We were turning positive, and then Monday happened and we turned negative. Now we're turning back to positive. There's no trend going on, though, because the ADX is below 20 and below its moving average. Also turning back more positive in the short term with the green line on top, but we're continuing to decline with the ADX. And volume was above average. So that has been pretty healthy there. We came down with the VIX on a closing basis, where in Monday session we actually opened above 20, and then we've been coming down with the VIX since then. Also declining with the VIX of the VIX as stocks went up and the VIX went down. We're coming back up here with the MACD, but we're still negative as far as momentum. Still getting a really high reading with the skew index, and we've been in this red area for last few months anyway. So there's really a lot of optimism, and research that I came across suggested that this move that's expected is still more to the upside. And we ticked up with this fear gauge where we ticked up with this other fear gauge. So a bit of a contradiction here. Some of our fear gauges went down where these last two charts that we just looked at went up as far as fear. We went down with the daily equity put call ratio chart. We're going back up with the 5-day chart after getting a really extreme reading here. And this is somewhat negative because when this goes up, that means there's more puts being bought than calls, and that's more hedging taking place. And we're getting a very low reading here with the longer term 5-day chart, but we're still going down with the 10-day chart. So a bit of a contradiction there. And we came up with the volatility risk premium, but we're still back up at the lower end of this range. Advanced decline line. We saw an improvement on Monday, saw a little bit of a deterioration here on Tuesday, going down based on price and volume, but still positive when taken together. We had a really, really high reading with the advanced minus decliners based on 10 days. It did come down, where on Monday's session it went up. Still looking good internally, an expansion of the new highs, not much in the way of new lows. So we're going up at the 5-day and the 10-day chart. Coming down a little bit, but still positive with the advanced decline ratio in the short and intermediate term. Really going up here with accumulation distribution. The boom indicator is all mixed up right now. we might be getting a little far away just by eyeballing this, with the indicator getting quite a bit above the moving average. That could be extreme. We're still looking positive here with our second smart money indicator, the chicken money flow. The red line's going up and the histogram went up. And we're starting to get extreme though with the chicken oscillator. So we have two of our three smart money indicators that are positive, but maybe a little too positive. But they could still continue to go up. There's nothing that says they have to reverse. And we're still declining here with the vortex, coming down with the green line and up with the red line, but this is still positive and showing an improvement longer term with the 10-day average of the highs and lows for the S&P. Going up based on price, actually declining here based on volume when you look at the cumulative S&P 500 data. And a little bit of a decline with the NYSE advanced decline line where we went up with the S&P. A little bit of a disconnect there. And going up with the cumulative advanced decline line for the NYSE, a little bit of an improvement here based on the regular NYSE advanced decline line, as well as this other advanced decline line. The takeaway from these two charts is that we're above the moving average. And both of these are calculated slightly differently. And also showing a little bit of a bounce with the NYSE common stock based on price, actually declining slightly based on volume. And a little bit of a deterioration here with our advanced decline line studies. Came down with the NYC common stock, the S&P, mid caps, and small caps. But these are still positive now because we're still above the moving averages. Still improving here with our broad market measure, the 5 period moving average of the highs and lows. So that's still holding up there. And coming down with our 20 period moving average study. These are the stocks inside of the S&P, which in Monday's session actually went up. Now it's starting to come back down after giving an extreme reading. When we're above 70, that shows good momentum. But when we get above 80, that means maybe we're going a little fast with this. And actually declined with our 50 period moving average study where we went up on Monday, and declined with the 100 period moving average study as well as the 200. And all these went up in Monday's session but came down in Tuesday's session. And still looking pretty good here on the daily chart, and we're also above average with volume. Coming down with our 20, 50, and 200 period moving averages on the S&P. Going up above the midpoint with the Stochk RSI, but not extreme yet, where we are starting to get extreme with the Williams percent R, bouncing back up with the CCI 14 and the CCI 20. The short-term stochastics are starting to get extreme right now. We're declining, but still extreme in the intermediate short term, still advancing in extreme with the long-term stochastic. And we bounced back up a little bit here with the force index where it had actually dropped to negative after Monday. The condition of the short-term trend, a little vulnerable right now. The green line and the blue line are going up, but we're dancing right around the lines. We're not above them like we were last week. But we're still above the 20 period simple and exponential moving averages. These provided pretty good support in Monday's session, and we were able to bounce off of that. Actually provided some support in Tuesday's session with the exponential moving average, and trying to fill in this gap here that we saw from Friday to Monday. Above the midpoint with our standard deviations chart, that's more positive. Balance of power above zero and advancing, that's positive. The lighter blue here, that's more neutral to negative. So we'll have to see if there's an improvement here after it had generated a buy signal, and then Monday happened and that threw everything into check there. The TTM squeeze continues to be positive, and we're still above the midpoint and going up with our highest high values. Declining, but still above the moving average with standard deviation, as we've been seeing a lot of movement within stock price lately. Negative with the ease of movement. We are still looking a little weaker from what this is picking up. The Erin just, okay, it's positive. Hasn't really reacted to what happened on Monday or Tuesday session. And we're no longer extreme positive with the McClellan oscillator. Now, it's a little bit of a negative divergence to have the S&P go up and this go down, where this had been giving us a very high reading, where it was positive on Monday when the S&P went down and this went up. So we're seeing a bit of a drop off here. But when we're above zero with the McClellan oscillator, we're positive with the summation index based on price and volume, declining with the NYSE McClellan oscillator, but still above zero. So we're going up with the summation index for the NYSE based on price and volume. This has been a warning sign that started to trigger last Friday. We're declining with the Swenlin trading oscillator with price and volume, and it hasn't changed. It continues to decline. Momentum is still positive. The PMO is positive. We're positive based on price and volume. Coming down with the PMOs that are rising. A little bit of internal weakness coming in here. We've stalled out, but we're extreme positive with the buy signals, but the PMOs that are above zero continue to go up. And we're neutral with the Elders Impulse system for the S&P. We're still positive with the parabolic SAR. We're just a little bit above the blue line here when we look at the condition of the intermediate term trend. And we're above all the plotted moving averages. We never did lose that. They provided support in Monday's session, and we're coming back up further from them in Tuesday's session. This is where we're getting extreme with the short-term slope oscillator. It's getting above the green line. We're still looking good with the MACD. All of our oscillators continue to go up in the short, intermediate, and long term. The Copic curve, another momentum oscillator, is still positive, going back up and starting to get extreme with the Sean trend meter. Kind of sideways here, but still above 50 with the money flow, and we're going back up with the ultimate oscillator above 50. That's positive. Still above the moving average with on balance volume. Above 50 with the RSI 14 and 9. That's positive. This is the mass index. There's three criteria. We get above the red dashed line, that's one. We go above the blue line, that's two. Now we've crossed back down below the red dashed line again. That's three, and it's picking up that there could be a reversal in what's happening here. And the context is, okay, were we going up? Are we looking for a reversal to go down from here? No, we don't base everything all around this, but it is giving us a signal now where we're still working off of a buy signal from the Pring bottom fisher. The BPI did go up, and that's suggesting an increase in the point and figure buy signals in the S&P, a primary indicator that is positive, and going up a little bit with the NYSE BPI and back up after dropping down with the NASDAQ 100 BPI above 50. So these are looking more positive. Still above the cloud, or actually, we were able to get back above the cloud here after Monday. That's turning positive. We have the blue line above the red line, and now it's really hard to see in here, but the green line's starting to go back up with our Ichimoku cloud study. This is the longer term trend channel I was talking about. We're coming up to the higher end. What I tried to do here is connect specifically these tops that we hit back in 2014. And then I went from the bottom at the great financial crisis, and then this is the bottom at the COVID crash. And so my chart looks a little bit different than some other charts that you see, but we hit this upper end, and then that's in December, and that's where we started to come back down. We're right at that point again. Is that going to continue to be overhead resistance? And we're going back with a doji type look here with the Heikin Ashi, where they have the open high, or excuse me, the open and the close just about even with each other after it had turned negative after Monday. We're back to looking positive with the Kegi chart, the Renko chart, and the three-line break chart. Long term, tick down a little bit with our 150 and 200 period moving average studies, even after they went up in Monday's session. Positive across the board on all time frames with the different stock indexes that we look at. We're back to positive in the short term with bonds based on price, where we're back to a downtrend with commodities in the short term, and the dollar continues to be in a downtrend, even though it bounced up on Tuesday. The three main growth areas are what drove the market in Tuesday's session: tech, communication, and discretionary. Financials were down, but that's another area that we like to see doing really well. Staples, which were really solid on Monday, they got hit the most in Tuesday's session. And more green here, especially with the NASDAQ going above 19.4, 5, 6, 7. We were below 6,000 with the S&P, but then we were able to get back above that. The financial sector is still looking good. We had a BPI cross above 70, and we had a MACD crossover with the NASDAQ. We'll see if we can get that. But that was right at the open. And then we ended up having a pretty good day there. Seeing a little bit of a disconnect here where we're going up with the S&P, we're going down with the equal weighted version of the S&P. And the Dow was up 1/3%, not at an all-time high yet, but not very far away either. Now, this is interesting. We go from positive to neutral on an up day with the Elder's Impulse system. Kind of strange there. The NASDAQ was up over 2%, getting really trying to recoup. It's really hard to see because this big P is right here, but we're well above the 50-day moving average. Also, a little hard to see here with the NASDAQ 100. It was up 1.59%. And that's what we've been seeing over the last 6 or 8 months is the NASDAQ, the broader index, is outperforming the NASDAQ 100, which is the mega cap stocks. And we've gone from negative back to neutral with the Qs when looking at the Elder's Impulse system. Momentum still positive. We're starting to roll over with the PPO. Now we're starting to turn back up after Tuesday. Cannot get above the 50-day moving average with the small caps, nor when we look at the Russell 2000 small caps, still below the 50-day moving average and still neutral with the Elder's Impulse system, still above the 50-day moving average with the mid caps but neutral with the Elder's Impulse system for the mid caps. Fang or Wilshire here, still above its 50-day moving average. This is still looking pretty good from a broad market perspective. Also, we had come down close to the 50-day moving average with the total US stock ETF. Now we're bouncing back up. Financial sector down slightly, but still looking pretty solid. The bank ETF, which I've been honing in on as interest rates have been going up, we're still above. We've spent 2 days now above the 50-day simple moving average. The FANG index back up almost 3.5% here, really bounced up nicely. These are the mega caps. And we came down to this longer term trend line, and now we're starting to bounce back up as the FANG index saw a nice little rebound there. Watching the robotics and AI ETF, we came down to the top end of the rainbow after Monday. Now we're starting to bounce back up. And then when we do a ratio between the robotics and AI ETF and the tech sector, we had come up to this 250 period moving average before, and that was acting as overhead resistance when we look at this ratio. We're starting to break above that a little bit here. That could end up being positive if it can follow through with more outperformance. Apple been looking really good, came down close to its 200-day moving average, now bouncing back up to its 50-day moving average. Amazon was up over 1%, setting an all-time high. Google was up 1.82%. It's been chopping around lately, but not falling apart either. Microsoft, which will report after the close, coming back above its 50-day moving average. Meta, which will also report up over 2%. Nvidia, which fell 17% on Monday, was up almost 9% on Tuesday. And we dropped below the 200-day moving average and we fell and went into a bear market that lasted a whole day. Now it's starting to go back up. And Tesla was up 0.25%, still dealing with its 50-day moving average. Netflix, virtually unchanged, but coming off of a recent all-time high. Still seeing a little bit of a drop off, but a strong relationship in the short term between US and world stocks, leveling off, but still strong with the longer term correlation. Oil was up. We're still dealing with the lower 70s right now. And semiconductors have a number of different charts here. We're still below the 200-day moving average with the SMH semiconductor ETF. It got some of that back, almost 2%, but it just got hammered on Monday. And this could be positive where we're bouncing off the 250-day moving average here. We'll see if we can get some more support that way. The Dow Jones Semiconductor Index also fell under its 200-day moving average and was able to get that back, being up almost 5%. This is the one that's been negative, the SOX Index. It was up 0.45%, still having a hard time getting above its 50-day moving average. And the semi to tech ratio has been really dropping off as the semiconductors, even in Tuesday's session, continue to underperform. The dollar coming back down close to its 50-day moving average and seems to be bouncing up off of that and still in an uptrend as I measure it. We were up with the 10-year yield. We were down with the 10-year based on price. And we've been keeping an eye on this too. The home construction to 3 to 7 year bond ratio is kind of chopping around lately, but underneath the rainbow, we're keeping an eye on Japanese rates with the 10-year yields. If they really start to go up, that could start to cause some of the problem that we saw last summer with the carry trade issue. And a little bit of a tick up here with Qs to S&P, but still below the moving average. A decline with discretionary to S&P, but still above the moving average. Coming back up, but still below the moving average when we compare large cap growth to large cap value. So with the large caps an improvement, we're getting back above the moving average. With the mid caps, we're coming back up to the moving average with the small caps. So what's our outlook? We're dealing with the earnings season now. We've got, and the reason these are underlined, and this was what's reporting on Wednesday, Microsoft and Meta. Apple's going to report, Amazon.com is going to report, Tesla, and about 40% of the market cap of the S&P is going to report this week. So it's a pretty big deal here. The FOMC is going to make their announcement at 2 p.m. Eastern. And we're still positive when we take the bigger picture with the mega caps and semis rebounding slightly. They've still got some making up to do there. We're going to get the MBA Mortgage Applications Index and the Advanced International Trade in Goods, as well as wholesale and retail inventories. Not a real influential report. The big one's going to be the Fed at 2 p.m. Eastern, and then all the geopolitical stuff going on there. And it's more domestic driven right now. What is Trump doing? A lot of people, this is great, this is wonderful. Other people are like, oh my gosh, this is terrible, it's awful. And so that's been really dominating the news lately. Then on Thursday, we're going to get GDP, the first look at the fourth quarter for 2024. We'll get jobless claims, and then we're going to get core PCE on Friday, another inflation gauge. So here's what it looks like for Wednesday's session with the economic reports. Not much of an edge either way here. We're neutral to positive with the Dow and Nasdaq, where we're neutral to negative with the S&P. And we do see some positive post-election year seasonality going from now kind of into the end of January here. So we kind of got that going for us. And this is just a different way of breaking down the seasonality. We're focused right now in the January area. This carries it out for the whole next year to some research that they've done at Stock Traders Almanac. Still dealing with the second half of January, which tends to perform well, where the first half tends to perform even better. Didn't really work that way this year. Small caps still really lagging behind, not going up the way a lot of folks had anticipated. And we're in the positive seasonality time here, according to Tom Bowley's research. So the equity put call, it's going up on the 5-day chart, but it's getting its extreme negative here, where it was giving a very low reading overall. The ease of movement is still negative, and the Swenlin trading oscillator. Not a long list right now, but this Swenlin trading oscillator, it was kicking into gear after Friday, and then we had the down day on Monday. It's still going down now, where most of the things are still positive. With our smart money indicators, we might be getting extreme when we look at accumulation distribution and the Chaikin oscillator. Still going up with the money flow, not really looking extreme there. And we're improving now with the rebound that we saw on Tuesday with growth to value as well as discretionary staples. And we're still going down with the 10-day equity put call ratio chart. The advanced decline, they're still positive, but showed some weakness. And we're not extreme with the S&P McClellan oscillator, but we're still positive with both the S&P and NYSE McClellan oscillators and summation indexes. We're still positive with momentum. The parabolic SAR and the bullish percent indexes are positive. The vortex showing weakness, but still positive. Our moving average studies are positive, even though we're coming down a little bit with the 20-period moving average study. The money flow, ultimate oscillator, and the financial sector, those are all still positive. And the momentum for the NASDAQ 100 is still positive. So our conclusion, we're positive and we're bouncing after a decline. And the areas that were weak on Monday showed the strength on Tuesday. The areas that were strong on Monday showed some weakness on Tuesday. Kind of interesting about that. And we're positive. We're giving a few overbought or extreme positive readings in both the short and intermediate term, where we're still positive with the intermediate term trend. And we continue to be positive with the long-term trend. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.